Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Monday Experiment edition of Wealth Matters podcast. Hope everyone is doing great on this Monday. Today, I want to talk about the HELOC strategy I am using to pay down my mortgage faster. We recorded this episode on when I started my Wealth Matters podcast about over almost 2.5 years ago. And this is podcast number 3. If you want to listen, you can go back and listen to that podcast episode on Apple Podcasts or Google or any of the podcasting platforms. As well as what I did, I recorded an interview or a webinar with Bill Westrom, who I'm working with on the HELOC strategy. If you want to reach out to me for that, do reach out to me. I can help you with the strategy. You can also work with Bill as well. So I want to talk about the strategy because I have been using it for a while and how it's working out for me. So first and foremost, what is HELOC? HELOC, the full form is, the short form is HELOC. The full form is Home Equity Line of Credit. What that means is that when we acquire a primary residence or rental property or vacation house using mortgage, the mortgage gets precedence. That's the first mortgage or senior mortgage. But if you have equity in the property, you can also get a home equity line of credit or HELOC. Uh, I'll just take an example with numbers so that it will help you guys understand that. Let's say I buy $1 million property, and don't laugh because I live in California. There are properties, or actually there are only properties which are at least $1 million or more in where I live, in Bay Area. uh, but let's say I buy $1 million property. I put down mortgage, 200,000 down, 20%, and take an $800,000 mortgage. In that case, I would not be able to qualify for HELOC. So we'll talk about that as well. But let's say I bought that property for $1 million. Now it's worth 1.2, 1.3 million. And I was paying down mortgage little bit, right? So my mortgage is now worth 750,000. So I am eligible to get a HELOC because HELOC usually the HELOC companies or the lenders want to make sure you have at least more than 60, or I would say more than the loan to value is 60%, right? So not 80%, which was the case in earlier case. So now that your loan to value is 60%, you'll be able to get HELOC up to 80% of loan to value as well. So the idea is that instead of trying to pay down your mortgage, of course, a lot of people would not agree with me that the interest rates are so low. Why would I try to pay down my mortgage? I do prefer to pay down my mortgage as well, but I don't want to lose that money from my pocket. So that's where HELOC comes into picture. Instead of me putting money into the mortgage directly, I will use HELOC and make lump sum payment to the mortgage. That way, I am not losing that money. Because remember, anytime you pay, let's say you had a mortgage again of that 800,000, and you are paying down principal and interest every month, but then every 6 months, or maybe you are making extra payment every year, or maybe every year. A lot of scenarios like, or some people do it like I do, that every year you throw another 20, 30,000 to that mortgage to bring it down. In this case, as soon as you put that money into mortgage, that's gone, right? Let's say there is a catastrophe event and you need that fund. Let's say there is a great investment opportunity and you want that fund back. You can't, right? Because you paid it against your mortgage. But if you are using HELOC to pay down that mortgage, HELOC acts like a credit card. I can go back, let's say another investment opportunity arrives. I can go to my HELOC and pretty much take another loan out, right? So HELOC acts like a proper loan or a revolving credit card. So, and I will be open and will share my experience right now. Just wanted to give you guys pretty good basic primer on how the HELOC works. Of course, I would highly recommend, and let me share my screen. If you are watching on YouTube, I would highly recommend to check it out. Check out the episodes, right, which I have recorded for further details. But I know because it was episode number 3, it's buried all the way below all the other episodes, because we are around 135 episode now. 134, 135 would be released soon. So, in case you want to learn a lot more about it, you can go to Apple Podcasts, as I'm showing here, and click on Pay Mortgage Faster using HELOC Strategy with Bill Westrom, and you can listen to that episode. Or you can always, if you want even more detail, or you want to see how Bill explains on the screen, you can go to my website, wealthmatters.com/webinar, and you'll be able to find the HELOC strategy webinar. You can click on play, and you will be able to see this. So, and I'm trying to share my screen here as well.
Where on the equity optimization side, we're doing the exact same thing the bank is doing, leveraging income against the debt.
So just wanted to share and show where all those podcast episode as well as webinars are located. Let's go back and talk about what I did. So when I started optimizing or paying down mortgage using HELOC strategy, I was at around 590,000 of mortgage. I am currently at about, I would say, in 3 years, around 490,000. So I have in 3 years paid down about 100K worth of mortgage, and I still, my HELOC is around 200,000. So what I do, the strategy is that I take money from the HELOC every year, once a year, make a lump sum payment, 20, 30,000 to the mortgage, and then basically all my income which comes in goes directly to HELOC. So that way, HELOC, if I had used 30,000, my income every month will come in and replenish the HELOC account, right? So, and also in between, I use that HELOC money to fund my investments as well. This is how I was able to acquire some real estate. As soon as then I'm able to refinance, or my income, let my income cover the HELOC payment. And I know you will have a lot of questions after this podcast, but the idea is that after even I paid down that 100K, I can still go back to HELOC and use it as credit card, take more money out, right? Idea is that if you understand how the mortgages work and how HELOC work, then you'll be able to see the difference. I know a lot of people will say, "Oh, my mortgage is 2.5%, 3%. HELOC would be 5%. Would it still make sense?" Yes, it would. In the end, if you are able to pay down your mortgage within a 30-year mortgage in 15 years, you will always be saving money on interest, right? And you can always go back and get another HELOC or another mortgage after you have paid it down. Let's say I pay down and I think, okay, now it's time. I can always go back and get another mortgage if time arises, or just keep that HELOC and or increase that line of credit on the HELOC and keep buying properties if you need to. But for the sake of simplicity, the way it works is that I would pay down the mortgage using HELOC, not pay down the entire thing, a lump sum payment, and all my income would go into the HELOC account, earning me, reducing my interest. So the way it works is that the mortgage is counted on your monthly balance, right? Not daily. So even if you pay your mortgage payment on 1st of month, 5th of the month, 10th of the month, or even 30th of the month, the mortgage amount will remain the same over 30 years. That's why it's called 30-year fixed. HELOC on the other side is a revolving interest and interest only loan. So the interest is counted daily, right? So in this case, I would, if I put money back on certain day in the HELOC account, which comes from my income, my interest would be reduced, right? Basically, instead of me paying the interest for 5%, uh, I am actually kind of earning the interest because I put the money back. So that was the whole strategy. It's hard to explain on the podcast. That's why I will highly recommend listen to the podcast and or watch the webinar on the website to get pretty good understanding about the strategy so far. And just this experiment so far seems to be working. I'm on the right track. In between, of course, it took me a little while. Actually, in 4 years I paid down 100 grand. But it makes sense. Why? Because in between I would take advantage of the HELOC and acquire properties as well, because I have literally 200K worth of HELOC sitting there. As soon as I needed to acquire a bigger property, I'll put the money back in HELOC so that it doesn't show up. My debt to income ratio doesn't get screwed, right? So this is how I'm able to leverage HELOC, and I highly recommend people look into the strategy. Even this is not an investment strategy, but if you let's think about it, some of the biggest expenses we have is one is the income tax, right? That's the highest. It's not going away. The second is mortgage, right? And third is the property taxes as well. If I'm able to eliminate one of the one of these expenses, I would be financially free, right? I don't think we can eliminate income tax unless I stop working. Yes, you can reduce income tax, and that's why I invest in real estate and a lot of other places where my money, or at least I always get tax benefits. Property taxes, no one can get rid of it. So I try to focus on mortgage as well. So my goal is to hopefully get rid of the mortgage in next 10 years, because every time, remember, you refinance for a lower rate, you are starting the clock again. Starting and every industry, the way it works, if you look at the life insurance industry, which by the way I like, on the whole life insurance side, and we'll talk about that as well in the next episode, uh, or the mortgage industry, they always ask you to pay the interest upfront, right? So the first 5 years when you refinance, you are paying a lot more interest upfront than you should be. So remember, it's the interest is not divided by 30 years. They always make sure that they cover their fees, right? All the lenders. So that's why whenever you refinance, you end up starting your clock again for 30 years, 15 years, 20 years. Plus, you are going to be paying a lot more interest upfront. So this is why I like this strategy. I personally did refinance last year as well. But definitely look at what you would be paying overall, and then look into HELOC strategy. Do reach out to me. I would love to help you guys. And if you can help me out here, please like and subscribe my YouTube channel. Or if you are listening to this on Apple Podcasts, please subscribe and leave a review. I'll greatly appreciate it. Thank you so much. Have a good one and enjoy investing.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!